And we are live. Welcome back, everybody, to Capital Cosm Live. The name being apropos as it is. We did go live earlier today, but due to connection issues, I just went ahead and scrapped that entire stream. We're going to start off from scratch. Standard disclaimer, as always, nothing on this broadcast is to be taken as financial or investing advice. Please do your own due diligence. It's your money, your responsibility. And just an FYI, there's two different sets of audiences for this video. The first set is those who watch it live. Those are the people that I chat with, in the live chat and so forth. But then we also have a second set. That's the people that watch the recorded version of this video. So what will happen throughout the course of this intro is that I'll kind of stall. I'll let some more people come in. I'll give a few minutes for people to come on in and join the broadcast. So if you're part of that recorded audience, then go ahead and fast forward a few minutes as we let people come in. So with that out the way, guys, I just wanted to take some time and talk about what we saw today after Christmas with the oil price. First and foremost, I hope everyone had a Merry Christmas. Everyone's enjoying their festive holidays. And we'll get started here in just a second. For the few of you that are early birds, go ahead and give me a 1 in the chat if you can hear the sound of my voice. And we will post this on X. And then we'll get started in just a few minutes. All right. Mutant Ryef in the house. How's it going, man? Hope you enjoyed your Christmas. Doing all right? So let's go ahead and kick this thing off. All right. So we have an article from Reuters. Oil jumps over 2% amid Red Sea vessel attacks and rate cut hopes. So the market, if you haven't checked, which I perfectly understand why you wouldn't, it is still the holiday season. A lot of you are off for the rest of the week. And so the markets are really slow. The markets are very illiquid at the moment. And because of that, you saw a pretty substantial rise in the price of oil, going from 73 some odd dollars and at one point breaking $76. So it says here, container ships attacked in Red Sea. Oil rose 3% last week. And the trade is thin because some markets are closed because of the public holiday. Exactly what we just alluded to. In addition to all of that, traders are beginning to price in rate cuts heading into 2024. So let's go ahead and dissect this article. So it says, oil climbed more than 2% on Tuesday at the highest level this month, as further attacks on ships in the Red Sea prompted fears of shipping disruptions and on hopes of interest rate cuts that could boost economic growth. So it's a mixture of two things, but I believe it's more so indicative of the things that are going on in the Red Sea. And if you aren't aware of what's going on in the Red Sea, basically all the cargo ships that go through this strait here, not strait, but the sea here, the Red Sea, between Saudi Arabia and I think this is Somalia? Or no, Somalia, I presume. All these ships that have to make their way from the Mediterranean through the Red Sea into, to be able to make it to countries like India, China, Pakistan, etc., this entire sea is closed off. So all of these ships have to redirect their passages across Africa and then be able to deliver their goods. So as you can kind of tell, this is causing shipping rates to rise. This is causing oil prices to rise. Number one, ships run on oil. They run on fossil fuels, and they're going to be running a lot longer because of the turmoil here. And so, and then on top of that, there's also speculative worry that this thing might escalate even further. And if it does escalate to a bigger war, then show me a war that's not inflationary. War is always inflationary. In this case, it's got to be inflationary. A lot of oil is tied up in the Middle East, whether it be through shipping and transport or actual production of oil, refining of oil, etc. So it says the rally in trade, with some markets closed for the holidays, added to the week's end of about 3%. And like I kind of alluded to before, we saw Brent crude hitting at $81. We saw WTI hit 75.57 at the close, but at one point it did actually cross 76. There's plenty of geopolitical tensions today in terms of the Middle East, and it has given angst here to the security of transit of oil and other goods, etc. Yemen's Iran-backed Houthi militia claimed responsibility for a missile attack on Tuesday on a container ship in the Red Sea for an attempt to attack Israel with drones. Israel minister on Tuesday hinted that the country had retaliated in Iraq, Yemen, and Iran for attacks carried out against it as the war with Hamas-led militants in the Gaza Strip widens to other areas in the region, etc. Blah, blah, blah. So, yeah, I mean, this is basically it. And as we head towards 2024, these issues could only get worse from here. That's a big reason you're starting to see this oil price rise. And then on top of that, oil has also found support from expectations that the Federal Reserve will cut interest rates next year. Lower interest rates cut consumer borrowing costs, which can boost economic blah, blah, blah. Yes, we all know that. Dollar index also edged lower. We'll take a look at that in a second. So what do they got here? Fed rate cut euphoria rides wave of retreating inflation. So in the minds of the Fed, they've been able to temper down inflation back down to the 3% mark. Now, 2%, that's 3% is the new 2%. But over time, 3% can compound to be significantly larger than 2%. By boosting best, not only that the Fed will begin reducing borrowing costs in March. So here's the thing. Markets are up, almost hitting all-time highs. And so what's really going on here? Let's go ahead and take a look at the charts really quick. And let's look at this thing on a candlestick basis. Here we go. So we've got oil currently trading at 75.29 at the moment. But if we zoom in here, you can see, it's really interesting. You see, these green candlesticks. See one here as of today. And you also see one big one here, another decent sized one here. So we're starting to see these big candlesticks close out the day, which is really interesting. And this was the day after Christmas, December 26th. The market's closed on that. The market has opened for the 27th. And so oil just kicked things off. You can tell here we had a reverse hammer candlestick, which is a reversal pattern, the day or the day before Christmas Eve, which was a sign that things could go back down. This essentially reversed that reversal. So you have a bullish engulfing, which is where you have this big green candlestick and it engulfs the entire preceding candlestick from the day before. So a reversal of a reversal is a reversal. Does that make sense? And so oil, we hit a high of 76.29 for the day. There is a critical level that we have to hit. And, you're looking at the $78 level. There's a lot of buying and selling that occurred on this level. So I think if we can make our way up there, break that $78 level, that'll be a significant milestone. That'll take us up to the next resistance line, which would be this $87, $88 level. I also want to look at the TNX, the 10-year Treasury yield. And this thing has been climbing higher, higher, higher for a couple years now. So let's go ahead and do some TA. Actually, it might be better to do it on a log scale. Boom. So we have this super long support line that goes all the way back to June of 2020. And look at that. We broke down beneath it. This is telling us that the 10-year is going down. And when the 10-year goes down, that's usually a sign that the dollar's weakening. Dollar's weakening. This is a tailwind for the stock market. This is a tailwind for our commodities. We're currently sitting at 3.88 on the 10-year. And, basis Fed funds rate wise, we are at 550 basis points. So the Fed could say, we want to cut 25 basis points by March, yada, yada, yada. The 10-year is already pricing in, damn near 200 basis points already. Almost 200 basis points. We got Toad in the house. Toad says APA's chart looks good. VTLE about to break out too. VTLE, what is VTLE, Toad? On the DXY front, we also see some headwinds to the DXY. The DXY is the basket currency relative to the dollar. So the more it goes up, the more it means that the dollar's overperforming other currencies around the world. The more it goes down, it means that the dollar's underperforming other currencies around the world. Where are we at today? Let's see. What can we draw here? How do we draw this? I mean, you can kind of see it. I mean, we already kind of broke down back in early 2023. If you use this support line as any indication. This is drawn on a log scale, FYI. And you can see here, if you switch between a log and linear scale, there really isn't much difference. We tried to retest this support line in October, failed the retest, we're heading back down. DXY showing some weakness as well. And so, how's gold doing? Gold has a quadruple top. A top here in August of 2020. A top here in February of 2022. Another top in May of this past year. And a recent top this past month. Quadruple top. What does that mean? It's, is it twice as bearish as a regular double top? But the price action of gold, where we did break an all-time high just a few weeks ago, all the while there wasn't much euphoria in the price of gold to begin with. I take that as a positive sign, meaning that you break an all-time high, and there isn't big, how do I want to say this, retail mania, retail euphoria in the mix there, that tells me there's a lot of juice that we could still pull from the mainstream, from the public at large. So I think even though we failed to fully break out past this line, we made an all-time high at 2150, but when we went back down, we're currently at 2076. The fact that we're still holding, that we didn't see any big mania, we didn't see any big euphoria with the move. It wasn't on. I don't know what CNBC. Maybe it was on CNBC and Bloomberg and etc. But from my perspective, people weren't going crazy about gold as, let's say, 2021 they were with crypto. And even so, we've come back down. I mean, you look at this move here, it's actually pretty encouraging. We came back down, and we're resuming our move up. Right? We have this support line. It's a pretty discernible support line. We hit it 3 times. That's the minimum requirements for a support line. And yeah, I mean, if you follow this support line all the way out to its intersection here, I would say at the very latest, gold has to make a move. It has to shit or get off the pot by February of this coming year. So the next month and a half, 2 months. Something has to happen. Either we break down below the support line or we break out of this resistance line. Commodities as a whole. Commodities, as you can see here, made a really big move at the start of 2020 from the bottom here in March of 2020 all the way up to the peak in June of 2022, moving in totality 224%. So we peaked in June, and ever since June we've been kind of grinding slightly down. We've been in this descending channel, and we can't seem to shake it off. But, I mean, this is a pretty strong green candlestick. Look how big this green candlestick is. Bullish engulfing for the last 2 previous trading days as well. So commodities making this downward descending flag pattern. And as you can see here, commodities broke down below this support line. Now, will they break down even further? Will they retest? Will they test this, this shorter term support line where we see this descending channel built up? Well, we'll see, guys. But I want to take you down a trip down memory lane. This is the commodity index traced over time, going all the way back to 1994. And let's look at this on a log scale. Doesn't look that much different. But, we made a significant high in 2022. Didn't quite retrace back to the old highs of 2008. But controlling for money supply, there's a lot more money today than there was back then. This chart takes on a much different look when you adjust for money supply. Look at that. So, on a linear scale, let's actually index this. All right. So, on a linear scale, we're still ways off. Even though we made this big move from 2020 all the way up to 2022, the move from 2020 to 2022 essentially brings us back to parity from where we were pre-pandemic. Okay? And so, and also, I mean, you look at this chart and you realize even in 2001, the start of the last commodity bull market, commodities were nowhere near as cheap given the amount of money in circulation as they are now. Think about all the money that was made between in the 2000s during that commodity super cycle. Now, and just realize that we would have to essentially, where are we at today? Well, you can't really tell here, but we would essentially need to 2.5x just to get to those cheap levels of 08. So we're cheaper than cheap when the commodities price, despite a massive surge over the last couple years. I want to also kind of look at the general market as well. Now let's look at the S&P. The S&P is making a double top at the moment. Looking quite good. You can kind of see it there. Double top, nearing all-time highs. You can also look at the NASDAQ. As well. NASDAQ also making close to a double top. You can also look at the Dow Jones. So they're all kind of making similar patterns. Oops. Yeah. And there's a real difference between, I mean, there are differences between these indices. The NASDAQ is more of your speculative index. The S&P is kind of like your domestic index, U.S. domestic. And then the Dow Jones is what foreigners invest in. It's more of your international gateway into the U.S. market. And so let's compare these three markets and see if we can glean something out of it. So let's look at the Dow Jones divided by the S&P. The Dow Jones has underperformed the S&P for quite a while now. The Dow Jones is actually quite cheap compared to the S&P. And this basically tells us that there's a lot more investing in the U.S. domestically has been a lot more palatable, has been outperforming in international investors. But as you'll see here, we've hit this support line. We also can look at the world stock market index, which is, I believe, this one, MWL. And it's weird, so you've got to look at it as a line. But the world index, the world stock market index, has also made a double top. But how has the S&P performed relative to the world? The S&P continues to grow compared to the rest of the world. We do have another double top here. Let's go ahead and look at this from a candlestick POV. And domestic markets in the U.S. continue to outperform the rest of the world. It's because as bad as the United States is, the rest of the world is a lot worse. You know, you can also look at this from a Dow Jones perspective. You put in the Dow Jones, and you see the same story. We actually hit support not too long ago. And so this is basically telling us that international capital, there's tailwind for international money to come into the United States vis-a-vis through the international index gateway that is the Dow Jones Industrial Average. And so when people wonder, well, you know, how could we be hitting on all-time highs with the stock market when everything looks so bad, right? Gross domestic income is down. All kinds of bad markers that we can look at, but the market keeps going up, and that could simply be because we're being propped up by so much international capital that's coming here into the United States. And people like Martin Armstrong have talked about this before. Whereas things begin to unwind with this global sovereign debt crisis, more and more capital from across the globe, from Europe, from Asia, etc., begins to find its way into the U.S. Not because our markets are great, but because they're a lot less shittier than the rest of the markets. So that's really interesting. Let's go ahead and look at uranium really quick. I don't think there's anything going on with uranium today. Spot price still hasn't moved from 91.20. Yeah, still the same. URNM, had a decent day. Still kind of flirting with that top here. Let's zoom out a little bit. So yeah, I mean, it looks like it's going to be crunch time by the end of the month, January. And that's when these two lines converge, this resistance line and the support line. So either two things have to happen. Either we break below the support line or we break above this resistance line and make new multi-decade highs with the mining equities. And also, if you look at the URNM miners ETF versus the metals price, this is as cheap as it gets. I mean, we've essentially restarted all the way back down pre-2021 uranium bull market. Price in uranium. All right, I think that's pretty much it on the energy charting front. I also wanted to show you guys this. So this is a really interesting tweet. This is from Andrew Cote on Twitter, or X. And this is basically charting out electricity and income per capita. Each individual bubble on this chart is a country. And on the x-axis, the horizontal axis, you have GDP per capita of each individual country on this visual. And then on the vertical axis, the y-axis, you've got electricity consumption. So, I mean, this is pretty easy to read. The higher your GDP, the higher your electricity consumption. I would actually chart this the other way around. Because I would argue that electricity consumption is your independent variable and GDP is dependent upon that variable. But anyways, you kind of get the idea here. And the main point is that, as they've kind of outlined in this chart, is that there's no such thing as a low energy rich country. Right? So each one of these high GDP per capita countries, they all use more energy, more electricity than the lesser GDP countries. And that's because GDP productivity is tightly correlated with electricity, energy consumption. How productive can you be with sticks and stones compared to your computer, lights to illuminate the room, your phone to make calls, etc. We're swimming in a sea of energy. A sea of energy. Hope you're wearing your energy scuba gear. You don't drown in the sea of energy. Or at least you've got like a nice little energy arc. You're just making your way across the sea of energy. What am I talking about? I don't know. We got some more people in the chat. Gustav Lunel is in the chat. Matt Bittner. Glad to have you guys here as well. Gustav says gold needs CBs to continue buying in 2024. Mutant Ryef says gold will really only take off with dropping the Fed funds rate and bringing back QE. I don't know if that's the only reason it would take off. A lot of these countries these BRICS countries, as well as non-BRICS countries as well, in the case of like a country like Argentina, they're going to be more likely to drop their currencies. And what are they going to buy? They're going to buy dollars, which is the case of Argentina. Milei's come in, and he's going to make it. I don't know if he already has. I think he already has, actually. He's made it legal to accept payments in the dollar, which in and of itself, say what you will about Milei, not stroking his you-know-what, but it does free up a lot of friction, pent-up energy in the overall market. And that's because, say you're a store owner, the Argentine peso is fluctuating to the upside rapidly, so you've always got to keep an eye on what the peso's worth, and you've got to adjust your prices accordingly, and et cetera, blah, blah, blah. Then when you get paid in pesos, you got to go and convert them into dollars or euros or whatever. Being able to just accept payment in terms of dollars just makes it a whole lot easier for business owners, et cetera, and it frees up a lot more time for them to be more productive. And so, yeah, I mean, if you're going to maintain this level of livability, of quality of life, then we're going to be using more electricity. And actually brings up my next article here. Energy sector not ready for rapid rise of renewables, analysts say. So this is from Yale Environment 360. They're a big, greeny publication, etc. But I think this chart's really interesting because it looks at yearly global investment in clean energy and fossil fuels. And what do you notice is that, post 2018, I want to say, there's a big divergence between clean energy investments and fossil fuels. So clean energy is getting all the money. Green energy is getting all the green, okay? They're getting all the green. Fossil fuels, I mean, they're getting all the shit. I mean, you see, they've got them colored here in brown, or at least like orange brown. They're getting all the sludge, all the stuff that no one wants, which is going to make these fossil fuel resources even more scarce. And I mean, this is more of a headwind for the supply side of fossil fuels, which is a tailwind for the price of all of these different fossil fuels: coal, nat gas, oil, etc. And so let's quickly go through what they've got to say here. Rapid growth of wind, solar, electric vehicles means that the demand for fossil fuels is likely to peak this decade in the energy sector for the transition. A survey by the International Energy Agency of Clean Energy firm finds that not enough workers are pursuing the training needed to fill the growing number of skilled jobs. This is great need in particular for trained electricians. The unprecedented acceleration that we have seen in clean energy transition is creating millions of job opportunities, but they are not being filled fast enough. So there you go. I mean, this is dumping cold water on the whole green energy transition. They've been getting all this money, and yet they can't even find people to fill up these roles. So you're starving the fossil fuel industry from much needed capital to keep the lights on, for lack of a better term, in favor of green energy that you can't even find the manpower to fully devote to. And so they say the oil and gas sector faces the prospect of being left behind by the shift in renewable energy. Yeah, we'll see about that. Currently, oil and gas firms account for just 1% of money invested in clean energy globally. Did you read that? 1% of money invested in clean energy. Oil and gas. I'm going to read this again. Oil and gas firms account for just 1% of money invested in clean energy globally. So they only have a tiny 1% fraction of all the money that's invested in clean energy globally, according to the IEA. And you're going to tell me there's not going to be production headwinds, supply headwinds? We'll see. If countries meet their targets to ramp up renewables, then oil and gas companies could lose 25% of their value, analysts estimate. So hold on. If countries meet their targets to ramp up new renewables. Yeah, well, they're not meeting their targets, as you can clearly see. So are these oil and gas companies going to lose a quarter of their value? Drop me a 1 in the chat if you think oil and gas is going to suffer an ill-begotten phase. Oil and gas companies are going to lose 25% of their value. Actually, no. I'll do you one better. Give me a 1 in the chat if you believe that majority of countries will meet their renewable goals or targets. Give me a 1 in the chat. Give me a 2 otherwise, if you don't think that's going to be the case. The next article here, Big Oil enters 2024 by U.S. industry consolidation. And it's basically talking about, let's go through this here really quick. Oil and gas industries went on a $250 billion buying spree in 2023, taking advantage of companies' high stock prices to secure lower cost reserves and prepare for the next upheaval in an industry likely to undergo more consolidation. So the big oil and gas companies, they know what's up. They're buying up more. They're buying up more reserves. And they're actually anticipating a surge in oil demand. It says here, a surge in oil demand as world economy shook off the pandemic downturn and has stoked acquirers' enthusiasm. You've got Exxon, you've got Chevron, you've got Occidental. They all made acquisitions worth about $135 billion in 2023. ConocoPhillips, they also completed 2 deals in the last 2 years. So they've been buying up all these reserves, about $135 billion worth of reserves. The grand prize in this deal making is the largest U.S. shale field, the Permian Basin in West Texas and New Mexico. The 4 companies now positioned to control about 58% of future production there. Each aims to pump at least a million barrels a day from the oil field, which is expected to produce, I'm going to highlight this, 7 million barrels a day by the end of 2027. So if you haven't seen my interview with Doomberg that I posted yesterday, I highly suggest you do. He actually brought up the prospect of a oil glut. So he actually thinks, barring like some catastrophic war that spikes oil up, especially like in the Middle East, then, you know, all these oil companies, they're going to ramp up production of oil from the likes of the Permian Basin, all these other fields that they've acquired. So let's go ahead and finish reading this article. And more transactions are on the horizon. 3/4 of energy executives polled in December by the Fed Bank of Dallas expect more oil deals worth $50 billion or more to pop up in the next 2 years. So yeah, you know, this thing isn't stopping. These guys know that we're not getting off fossil fuels like these guys here think. Okay? These guys, the guys that run Chevron, the guys that run Oxy, the guys that run Exxon, they know what's up. Their head's not in the clouds. Save them what you will. But at the end of the day, they have their fingers on the pulse of the energy market. Consolidation is actively changing the landscape. Select few companies will determine whether production will be strong, blah, blah, blah. And yeah, they pretty much just go into rising interest rates here in 2023 made paying for acquisitions with stock more attractive to investors than funding new renewable projects with cash. Offshore wind projects in the U.S. and France were canceled due to increasing interest rates and supply chain costs. So there you go. The Fed hiking rates to 5.5% has effectively choked off this green energy movement. And it's actually allowed for these big oil producers to come in and buy up all these fields. And it's, you know, this is really interesting as well. So it says here, producers have also recognized that the U.S. move towards renewable fuels, EVs, and greater efficiency will cut fossil fuel consumption and squeeze companies with high production costs. Where is it? Consolidation has prompted U.S. antitrust regulators to ask, blah, blah, blah. I think there was something here about offshore drillers they mentioned. Oh, here it is. Okay, it says here, offline operators face their own consolidation wave with fewer new oil and gas pipes being approved and built. Okay, so these are offshore oil service companies. The consolidation will have spillover effects on oil field servicers and pipeline operators. The companies that provide drilling, hydraulic fracturing, and sand and transport oil and gas to market are entering an era of fewer customers wielding more power over pricing. So these oil services companies, cheap as they may be, I'm an investor in quite a few of them. In this article, it says that there's less and less people, less and less customers in the market for these operators. And so they lose a bit of leverage in the process, which can kind of squeeze their margin. Like it says here, consolidation is good for producers, but doesn't help service companies at all. It will squeeze their margins as existing contracts are renegotiated. All right. So let's go ahead and pull up the chart here for OIH. This is the Oil Field Services ETF. And OIH has actually been fairly reliably moving up this channel here. Boom, hits its head up, drops all the way back down, hits its bum on the support line, hits its head on the resistance line, and you know, that's just what we've been doing here with the OIH companies, oil services companies. It's been steadily moving on up. And if you look at this thing from a log scale, you could make the case that we are at support, and we are perhaps ready to bounce back off for another round of this cycle. So that's interesting. Speaking of rate cuts, this is an article from Reuters. Reuters says that good times are here again. Fed Reserve policymakers are set to start the new year with fresh evidence that their 2022-2023 interest rate hike campaign puts U.S. price pressures firmly in retreat. And it says, showing that by some key measures, inflation is now at or below their 2% goal. Okay, well, they think they're back down to 2%. So that said, these guys are gonna signal to the market. They're trying their best not to signal to the market that they're going to cut rates too bad. But the gold price might be starting to sniff this out. Gold launched all the way up to 2150 the other week, and that might be a sign of things to come. Remember, gold spiked in 2020 before the inflation print came in 2021. So gold's a leading indicator. Traders broke out the champagne after a government report showed the personal consumption expenditures, PCE, price index fell 0.1%, the first decline on measures since April of 2020. And so they're costing Fed policymakers may not be quite as euphoric, noting that much of the decline in November came from the fall in good prices that is unlikely to continue, at least at the same pace. And a lot of it also came from gas prices coming down. So let me ask you guys. You're stewards of consumption, right? I mean, do you get the sense that prices have only risen 2% on a year-over-year basis? Maybe gas prices haven't. Gas prices have probably gone down, but from your own personal experience, do you feel like your expenses have only gone up 2% in totality? Give me a 1 if you think that's the case. Give me a 2 if you feel like it's gone up way more than that. Okay, so last week the Fed kept its policy rate in 5.25 to 5.5% range, and Jerome Powell signaled that the rate hiking campaign that began in March 2020 is likely over. Policymakers would next turn to a debate over the timing of rate cuts. So, yeah, there you go. This is very bullish for commodities. And, actually even rate hikes, when you think about it, are bullish for commodities as well. Rate hikes put a clamp on highly capital-intensive projects, which include things like mines and oil drillers and all these other things. And so it makes it harder to fund these projects, end up causing more supply deficits down the line. And as is the case with a good number of these economic actions, you don't feel the ramifications up until a year or more later. There's a lag here between changing interest rates, right? Increasing interest rates by 550 basis points within the span of a year, and then what happens? You've got to wait. I think it takes like a year. If I remember this correctly, it takes you about a year to feel the ramifications of the rate hiking cycle or the rate cutting cycle. It's not an on and off switch where you just cut rates or hike rates and you automatically get like an immediate sign from the market. Guys in the chat, what do you want? Do you guys want to read more articles or do you want to look at more charts? Give me a 1 if you want to look at. If you want to read more articles. I got a few more articles here to read, or we can look at more charts. Give me a 1 if you want to read more articles. Give me a 2 if you want to read more charts. All right. Okay, prove me wrong too. Awakening says 2. I think that's a... all right, we'll go ahead and look at some more charts in here then in a second. All right, chart time. You know what? Let's look at uranium. So what I'm going to do, I'm going to put the uranium price at the top in yellow. And then I'm going to put this is the homemade ETF that I made. So URA doesn't go all the way back to 2008. So I made my own ETF, I made my own index. So we can get a clear idea on how much we've got to retrace back to those old highs. Prove me wrong. Oh my God. In the chat. Hit the like button, guys. I am a terrible YouTuber. You know, I don't promote this channel like I should. I don't do like, oh, hit the subscribe button down below. Hit the like button. Smash the like button. You know what? Hit that like button. If you're enjoying this content, hit that like button. Subscribe to the channel if you haven't. What else? Share the live stream with your other investor buddies. Do all the other stuff. Do all the YouTube stuff. I've also got you can also buy me a coffee. That should be in the description box below. You can donate to me in the channel. Kind of help the channel grow in a monetary sense. I also have an affiliate link with Uranium Insider as well. So if you want to take part of this uranium bull market of epic proportions, there's been a lot of angst in terms of why aren't the equities moving, and given that the spot prices moved. Well, not all these equities are going to move. There's only going to be a select few of these uranium equities that are actually going to see any action. The rest of these equities aren't going to see any action. They're all going to get blue balled, while the other ones, the small select ones, are going to get yellow balled because they're yellow cake, right? So the blue balled ones are like your shitcos that are never going to develop a mine. They're never going to cash flow, etc., which is the vast majority of these uranium juniors. As John Palmy likes to put it, I was watching his show the other day, and he makes the case that there's going to be a lot more uranium juniors coming into the market as this uranium market begins to form, as this bull market begins to form. So you've got to know which stocks to pick. That's why I highly suggest Justin Hune's Uranium Insider. You not only get access to his abundance of research, his newsletters, his monthly newsletters, but you also get his stock picks, his portfolio. Him and his team, this is all they do, right? This is their full-time job. You need a full-time job to thoroughly and adequately measure and research this market. And a lot of us, we have day jobs, we've got other things we got to do. And so the way I like to think about it, you're your own business. You're your own company as an investor. And so when it comes to researching specified sectors like uranium, you could think of something like Uranium Insider as your own personal analyst. You're outsourcing the research portion to your analyst, which would be Justin Hume in this case. You get access to all of his stock picks. You'll have a higher chance of picking the right equities, so you have a good seat at the table when spot's already moved. Okay, guys, like it's not going to start moving; it's already moved. So if you're going to join Uranium Insider, do so through the affiliate link in the description box below. All right. Thanks, Prove Me Wrong. I appreciate the reminder there. I always forget. I also got to promote myself. Lane Colbert says, if oil and gas companies lose 25%, it is a screaming buy. I think they're screaming buy right now, but maybe not a screaming buy, maybe just a buy. But yeah, I will definitely scream if they go down another 25%. Live on stream. Scream as loud as I can. Okay. Anyways, so what I was saying, you've got your custom-made uranium ETF here at the bottom. You've got your uranium spot price here at the top. And so you look at where we are today versus where we were yesterdecade, with the uranium spot price. We're at $91 today. You know, we're only about 66% off the all-time high. But nonetheless, when you look at our ETF, it's indexed at 2, whereas the high was indexed at 18. Okay? A 9x move. That just goes to show you how undervalued these uranium companies are compared to where they were at their peak. And if you look at this thing from a log scale, dating all the way back to 2007 to today, we've clearly broken out. People are saying, oh, what's going on with the uranium equities? Well, if you track these things down on a long enough time scale, you'll notice that they actually broke out back in the summer this year. Clear breakout from this resistance line. This resistance line goes all the way back to 2007. So when you break out of a resistance line, the older it is and the more times this resistance line has been hit, the more violent the move up to the upside. And so I'm under the belief it hasn't fully materialized yet. We're kind of like still hovering around this top area. Actually, we have, looking at URNM, we still haven't broken out of the top. But if you look at another basket of uranium companies, I've got CCJ, DYL, DPLO, Paladin, Boss Energy, UUU, Mega Uranium, Bannerman, Peninsula, Elevate, etc. These are what make up this index. And the reason why I chose those is because, number one, you've got to have companies in your index that can trace back to 2007, have a trading history. And so a lot of these old uranium companies simply went out of business. And that's what's going to happen in the future as well. So we progress towards this uranium bull market. You'll have more imposters come in. And then when it unwinds on the other side, all the imposters die off. And you'll have new imposters come in on the other side. So, I mean, this is telling you a 9x move just to retrace back to those old highs. Granted, there's a lot of share dilution in place here. But at the same time, there's a lot of inflation here as well. There's way more money today than there was back then. So it's a two-way street. There's no fully accurate way. To fully be able to measure this, you would need the collective market caps of all these companies over time. And then you'd want to compare it with... You want to look at it through time. And so I believe I'm actually thinking about this live on air. I think that the peak market cap of the bull market of 2007, 2008 was $150 billion. Chat. Fact check me. Is that right? I believe it's $150 billion at the peak of 2007. Today, you're looking at somewhere around where is it? I saw it the other day. I think it's like 45 billion to 50 billion. Okay, here it is. Yeah, so total market cap of the largest 33 uranium companies, 59 billion. So let's think about this. At the peak of 2007, you had a $150 billion market cap. Today, it's $59 billion. Now you say to yourself, okay, so that's about a 2.5x from here. But hold your horses. Hold your horses. When you pull up M2 and hide this, we've got $20.7 trillion out and about this very moment right now. And in 07, you had 7 trillion. So that's a 3x difference. There's a tripling. So now you think to yourself, okay, I have my market cap went from, let's pull up a calculator. So my market cap went from 150 billion down to 59. It's 59 today. 2.5x times 3 to account for the tripling of the money supply. If uranium, this is again a projection. This isn't like high-end projection. You know, these aren't high-end statistical analysis, but you're looking at a 7.5x just about from current equities prices in totality. Does that make sense to you guys? That's only if we retrace back to the inflation adjusted 07 highs. So if you adjust $150 uranium to today's price, then it's going to be a lot more. I think it's like 200 today's, or probably a little over 200. So if we hit that 200 mark, you can expect the equities to 7.5x from here. Some people think that we're going to far and away exceed that price. So 7.5x might be a little too conservative. So we'll see. We'll see where this uranium market takes us. Let's look at U.UN. And let's go back to candlesticks. And let's go back to the daily candlesticks. I mean, check this thing out. Continues to march on higher. Now, I will say, this does make me a little nervous. This pattern here does make me a little nervous. Feels like we could be hitting a top here. This ascending, I don't know what you call it, but this pattern here, typically, probability-wise, tends to come down once it has to make a decision whether to come up or come down. And this doesn't... Keep your eyes peeled. We've moved up quite a bit in the last year. 2023 was a big year for the uranium market. Okay, so prove me wrong. Let's look at XOM. So Exxon Mobil. You guys know, you guys know what Exxon Mobil is, right? And let's pull up a long-term chart here. Also seems like it could be hitting a double top, but it looks like it actually broke out of the double top. Could be retesting. And yeah, XOM's been looking pretty good. Let's look at XOM priced in oil. XOM looks fairly priced in oil at the moment. Let's do some regression analysis on this thing. And so regression analysis is the best fit line approach. It's a statistical method. And the reason why you do it is because you can kind of glean whether, something is... So basically what we've got here, we've got a best fit line here in red, and then we've got these two blue lines at the top and at the bottom. The top line tells you your 2 standard deviation range. The bottom line tells you your -2 standard deviation range. If you break out of this blue line, then it's kind of an anomaly. If you break out of either one of these blue lines, if you break out of this blue line here at the top, it's a 2 sigma event, and so the likelihood of you coming back down is very likely, more likely than not. Same thing for the other side. And so it looks like Exxon is fairly priced. It's just about hugging this regression line. So yeah, I mean, Exxon, given the current price of oil, is, I wouldn't call it cheap, but it's fairly priced. All right, we got Brian in the house. Brian says spot uranium might be the single biggest anomaly we will witness in the investment sector ever. Yeah, I mean, as I alluded to in a previous live stream, I'm not going to name names, but certain people have told me that these big name, big money hedge fund guys that are in this space, they're thinking of numbers that they can't even say in public. 1,000. That's what they think. As high as that amount. Because it's going to get stupid crazy. All right, Awakening TV2. Yeah, guys, I don't mind looking at individual stocks. I probably won't do it all the time, but if you want me to for sure look at your stock, be sure to drop a super chat. Then I'll look at your stock. But Awakening, you're a pretty active person here on these live streams, so I'll go ahead and do this one for you. Chevron, let's go ahead and look at Chevron. Okay, so it's actually imposed this regression line onto Chevron. And Chevron's actually pretty underpriced. If you draw a regression line from March of 2020, which is, I think it's a pretty good starting point, right? That's kind of like when the market all reset. Chevron's actually, it hovered below this 2 standard deviation line, and a 2 sigma event is extremely rare. I think it's like 1% chance that it ever occurs. So of course it's going to rebound back up. So the chances of Chevron rebounding back up, I think, are higher than Chevron continuing to come down. Chevron's PE is... Does TradingView not do PE values? Hold on, let me see. Market cap, dividend, blah, blah. Chad, if you go search on Google Chevron's PE value, I'd appreciate that. Oh, Petrobras is about 3.5%, Matt says. Okay, so here it is. Current PE value is 11.23. Yep, Awakening got it. Oh, prove me wrong. Coming in with the subscribe. Thank you, my friend. You know, I've seen you on these live streams for a long time. I just assumed you were already a subscriber, but, you know, thanks for subscribing nonetheless. You guys want to look at, let's look at coal. I don't hear many people talking about coal lately. What's going on with my TradingView? Let's look at coal. See what coal's been up to. Coal looks like shit. I mean, look at that. Which is my kind of stock. My kind of asset. Yeah, so look at coal. Coal's been in this consolidation pattern for quite some time. Actually, let's look at this thing on a weekly. Do it on a candlestick basis. So yeah, coal is squeezing. It looks like coal may have broken out, actually. Look at that. You guys see that? Is now the time to start buying coal mining stocks? Could be. We're down $136. We peaked up in the 478 region. I don't know about you guys. When you look at these coal mining stocks, they're pretty high dividends and super low PE ratios, etc. Coal's back down to this level of support. A lot of support here at this $116 level. Looks like we tested this level and succeeded. We passed the test. Let's look at Nat Gas. How's Nat Gas doing? Let's turn off this linear regression for a second. Nat Gas has been all over the place. It's very volatile. Nat Gas. Look at this thing on daily candlestick. Yeah, so we had been moving our way up this channel here, and we broke down below it. But we did rest our head on this support, so there's that. We bounced off of it, and it looks like 290 or so is probably the level we need to hit to kind of signal to us that we're on the right path up. So yeah, I mean, Nat Gas not looking so good, but coal on the other hand actually looks pretty good. Let's look at this thing on. It's already on. No, let's look at this thing on a log scale. And yeah, Nat Gas does not look good. But coal does, which is interesting because they're usually correlated with one another. Matt Binter says, Bittner says, how high dividend on the coal shares? It's pretty high. There's some as high as 10, 15, 20% actually. Okay, guys, is there anything else we can look at? Let's actually look at the gold to silver ratio. See how that's coming along. Gold to silver ratio. Let's index this. Huh. Why is it giving me this small time period? Let's do... Okay. Okay, so this goes all the way back to 1975. This is pretty good. All right, so gold to silver ratio. We want this thing to come down if you're a gold investor. And that's because during times of gold euphoria is when you start seeing silver move. And so silver begins to outperform gold in a gold bull market. So you want this to come down, indicating that silver is underperforming gold. Gold is underperforming silver, or silver is overperforming gold. And we've just been squeezing. It's getting close, guys. I mean, looks like something's about to happen here, right? Like these two lines are about to converge in summer of, actually no, never mind. Summer of 2025. I don't know. They could keep going. But yeah, this thing is converging. Looks like really hard to tell. Silver is really not doing anything. It's been stuck here at the $24 level. Let's look at energy. Prove me wrong. No, I am not a trader. I'm not a day trader, no. I am well aware that more people lose money than make money on day trading, and I don't think of myself as highly as being able to be that slim margin of people that are actually making money off of it. So, no, I don't day trade. I think my edge is to hold on to things for a prolonged amount of time. I think that's why I was able to kind of stomach the downturn in commodities and uranium and gold over the last couple of years since we peaked in 2022 is because I bought into these things at an early stage back in early 2020. And yeah, I mean, you've got to have an edge to make money in the markets. My edge is that I'm impatient. I'm just patient. I can wait. But then you also have to have the luxury of not needing that money. That's another thing. It's one thing to say, just wait around and collect on when these things spike. But sometimes you get in too early and you may end up holding for years, maybe decades. Being early is just as bad as being wrong. So, it's I don't do day trading. I don't know. Anytime I day trade, I always lose money. Get too emotional. I don't feel like I'm that emotional actually when it comes to long-term investing. I can see a thing come down. I can see an asset come up dramatically, and it doesn't mean anything. But if I'm day trading a thing, that's kind of my weakness. Why, are you a day trader? So yeah, we've got all right, so we're looking at the energy sector as a whole. And almost the same story as the commodities. Energy spiked. Forex, 305% from the March 2020 lows all the way up to the December 2022 highs. Oh, nice. So you are a day trader. Okay. Well, I might want to learn a thing or two from you then. We can, come on the show and just do some live day trading. See how it goes. But yeah, so energy as a whole, we just bounced off this support line. And, we'll see how it goes. Really nothing to indicate energy is about to spike. But let's look at some of these newer candlesticks. Well, thank you. Prove me wrong. Glad you find it compelling. So yeah, we'll keep eyes on XLE. Let's look at XLE versus the S&P. I want you guys to look at this one. Look on a weekly. And just check this out. Really good support line. Consistently touching these points here. And then a super long-term resistance line. And this resistance line goes all the way back to the 08 peak. Or right before the 08 crash, I should say. So XLE has underperformed the SPX, the S&P, the market, for the better part of a decade and a half. Now it looks like things could pop off. And the thing with these lines intersecting, guys, doesn't mean that it has to pop off at this date. It just means that by this date, it would behoove you to not see anything happen. Because you either have to continue on the support line or continue down the trajectory of this resistance line. So one of these lines has to win. Is XLE going to continue underperforming? Is energy going to continue underperforming the S&P? Or is it going to be the other way around? And if we do see a reversal, I mean, you're looking at a 4x, a 285% move. Back to the upside. So, if you guys can't see it, here's the full extent. Alright, so we've been going on for about an hour and a half. If you haven't done so already, hit the like button, subscribe to the channel. If you're watching this as a recorded version, then comment down below. Let me know what you think. Do you agree or disagree with some of these diagnoses? Don't really know the plural there. Comment down below on what the plural is for diagnosis or prognostication is. Really appreciate that. If you want to support me, you can also buy me a coffee. The link to that is in the description box down below. If you want to get an edge in the uranium market and get access to Justin Hune's repository of uranium-based research, his stock picks, access to his webinars, his private webinars, highly suggest you do. Please use the link in the description box below. Please use my affiliate link with Uranium Insider down below. I'd really appreciate that if you do. And that's all I got, guys. I have some interesting guests coming up this week. One that you've all heard of and, who's been on the channel before, who I think you'll be really excited to hear from. So with that said, enjoy the rest of your night. Merry Christmas, belated Christmas, happy holidays, and I'll probably see you before New Year's. Anyway, so thanks for hopping on.